Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, January 26, 2024. Yesterday, another data point emerged that supports the notion that the economy continues to grow at a healthy clip despite the Fed's attempt to suppress demand by raising interest rates over the past 2 years. During the fourth quarter of 2023, U.S. gross domestic product grew at an annualized rate of 3.3%. At the same time, the annualized growth rate for GDP during last year's third quarter was revised downward to 4.9%, which is still a very healthy clip. In fact, here's the snapshot of the report that I'm showing you now, and you can see for the past 6 quarters, all positive numbers. Now, prior to the third quarter of last year, you can see the numbers were starting to go down, and that's when the stock market was starting to get a little weak. But third quarter, everything just kind of came roaring back to life. So I've included a link to the report here in case you want to take a look at it. But that's a very healthy rate of growth, all things considered, for the U.S. economy. The economy is not growing that fast since the fourth quarter of 2021, shortly before the Fed began raising interest rates. After 2 consecutive quarters of contracting during the first half of 2022, the economy has not only avoided slipping into recession, but it's gained momentum over the second half of last year. That unexpected development may dissuade the Fed from cutting interest rates as soon as Wall Street was expecting a few months ago. At that time, the consensus was for a rate cut in March, followed by more rate cuts later in the year. Now, that timetable may be on hold pending more data. We'll get a better read on that next week when the Federal Open Market Committee announces its policy decision on January 31st. However, one data point that will weigh in favor of a rate cut, and I'm going to click over to that screen here now, is this morning's Personal Consumption Expenditures Index report for December. Last month, PCE grew at an annual rate of 2.6%. Now, if you look at the report and you go down this far right column here for December, and you come down here where it says price indexes, the first one is PCE, including everything, trailing 12-month growth rate of 2.6%. When you exclude food and energy, bumps up to 2.9%. However, that 2.9% is less than the previous month's 3.2% annual growth rate. Now, the Fed puts more weight on PCE than it does CPI, or Consumer Price Index, as a measure of inflation. So this could keep the rate cut scenario intact, but we'll kind of have to wait and see what they say next week. In the meantime, there's plenty of other data to keep the analysts busy. Every day, dozens of companies are releasing their Q4 and full year results along with guidance for this year. Thus far, those numbers have been encouraging enough to push the S&P 500 index up to a new all-time high every day this week through Thursday. Don't know if that's going to happen today, but has happened for the previous 5 days going into the end of last week. Clearly, Wall Street believes the risk of a recession is low, and it's time to pile into stocks. I agree, which is why I'm making some changes to the personal finance growth and income portfolios. This month, I have removed 2 underperforming holdings from the growth portfolio and moved 1 holding from the growth portfolio to the income portfolio. I am doing that to raise the average yield of the income portfolio while making room to add new holdings to the growth portfolio. In the meantime, most of our current growth portfolio holdings are trading below their respective price limits. That means I believe they have not yet become fully valued and are worth owning at today's price. The same holds true for our income portfolio, which, by the way, now sports an average annual dividend yield of 5.3%. So that's a very healthy yield in today's market. You take a look, by the way, a quick look at the S&P 500 over the past 6 months. Again, you've heard me talk about this many times. Here it is bottoming out at the end of October, and really just a very nice growth, had a few little blips, and here it is hitting record highs over here on the far right pretty much every day for the past week. So, and meanwhile, let's take a quick look at the 10-year Treasury note. A couple of months ago, when people thought that the Fed would be maybe cutting rates fairly early this year, and you can see over here the yield in late December got down to about below 3.8%. But as some of these other data points came in suggesting that economy was still strong, employment strong, consumers are still spending, it's kind of, see crept back up to above 4.1%. Here it is today at almost 3 o'clock in the afternoon at 4.16. So, looks like the bond market's starting to think that maybe next week when Jerome Powell announces the Fed's next monetary policy decision, he may use language that gives them a little more leeway on precisely when they may start cutting rates. So that's this week's PF Video Update, and I look forward to talking to you in another week. Thank you.